You're with us on Open Exchange, and we are coming to you live from the CNBC TV18 Motilal Oswal studios. Let's quickly get the top picks in with our technical experts. We do have Sudarshan and Mitesh with us. Mitesh, let me come to you. So what stocks are you working with today?
So I again have whole buy calls today. A couple of PSU banking names on the list, PNB and Canara Bank. I have a buy on Canara Bank with a stop below 299.5 for a target of 320, while PNB is a buy for targets of 55 and suggests a stop loss of around or just below levels of 50 here. The other buy call is over reality. Keep a stop at 876, look for targets of 920, and L&T Finance, that's a buy with a stop below 90 for a first target of 96.
Okay, all right, got that, Mitesh. Sudarshan, what about you? Any stock picks?
Well, again, I also have only buy ideas. ACC is a buying opportunity. The stock seems to be coming out of a very long correction. Buy with a stop under 1800. Havells is a buy. Havells has been, after a big rally, it has been moving in a trading range for almost 3 months. That range, given the slightly upbeat nature of the market, that range should break on the upside. It's a positional trade, so don't expect and don't look for an intraday trade here. In any case, as SEBI has told us, only 1% of intraday traders make money. So be a positional trader. Keep a stop under 1135. IDFC First Bank is a buying opportunity. The stock is probably completing a brief correction. Buy with a stop under 55. And Manappuram is my last buying opportunity. Again, a buy on dips. Big correction. That correction may be ending. It's a positional buy with a stop under 101.
All right, thanks a lot for that. Well, that's the first opening tick. The rupee has opened a tad bit expensive, at least stronger compared to what we saw on Friday. 81.97 was the close on Friday. 81.77 is where we're at currently. And for the equity markets as well, there's some green that we're seeing. So let's get Chandan Taparia, derivatives and technical analyst at Motilal Oswal, to help us with some data. Chandan, good morning and happy Holi to you in advance and to your entire team at Motilal Oswal. How are you feeling about the market? Do you think this pullback rally could sustain? What are the levels that you're looking at and what are the stocks to watch today?
Good morning, Sonia. Wish you a very happy and colorful Holi to entire team at CNBC, all the panelists and all the viewers. Thanks for all this colorful support in the live. So talking about the market, we have seen good recovery in last couple of days. The Nifty has managed to find support near to 17,250, 300 zone and witness good recovery. So I believe that this momentum could extend to us 17,777 to 17,850. So one can use buy on decline stance after the strong stellar rally on Friday. So use the support of 17,444 to buy this momentum on higher side. If I look at the data setup, FI's long short ratio has improved to 23-24%. Put call ratio of Nifty is near to 1.28 and India VIX is near to 12. So lower volatility with surge in the PCR and FI's ratios indicate the bullish bias is again coming at the support zone. Now, if I talk about the Bank Nifty, which is continuously outperforming, it respected to the budget low and now it is all set to head towards the budget high level. So with support of 40,750, your Bank Nifty has potential to head towards 42,000 in coming days. Now talking about stock wise, we have more positivity on selective private and most of the PSU banks name. So first recommendation in buy on SBI, 25 days long consolidation breakout with short covering. Stock has turned from key support of 500, 510, which earlier also it rallied and headed to 600. So same support is working well. So we are recommending to buy with a stop loss of 550 and expecting it to head towards 590 level. Second trading ideas, that is buy on GAIL, Gas Authority. We have positive on most of the power energy stocks and gas companies. So GAIL is buy. The stock has given a breakout from its pole and flag breakout with surge in the volume. Positive price setup with sector performance indicate 5 to 6% rally can be seen in the stock. So one can buy with a stop loss of 103. Here we have a target towards 112 level. Last trading area, there is buy on Zydus Life Science. Our narrow range confirmation is clearly visible. A small follow-up could cheer the stock to 5 to 6% rally on upside. Sustained buying interest is clearly visible on the chart with long built up. So one can buy with stop loss of 463. Here the stock has potential to rally towards 500 levels.
All right, thanks a lot for that. Thanks for stopping by as well. By the way, the Adani Group stocks in pre-opening are soaring, some of them at least. Adani Enterprises up about 9%, Adani Ports up about 2.5%. Despite ICRA revising its rating outlook to negative from stable on Adani Total Gas and Adani Ports, Ports is doing pretty well, up about 2.5%. But let's talk about the auto space now. Motilal Oswal has written an interesting report where they talk about how the automobile sector is back from the brink after 5 years of a downturn. The going was not good for a long stretch, but now things are improving, headwinds are receding, demand is moving up. So let's find out what the way forward is. Jinesh Gandhi, who is one of the co-authors of the report, joins in to talk about that. Jinesh, good morning and thanks for joining in. Can you tell us, in terms of, all of the tailwinds that you speak about in your report, whether it is receding cost tailwinds, favorable mix, favorable forex, as well as an improvement in demand, which is the biggest beneficiary here on, both in terms of valuation upside as well as growth upside?
Hi, good morning, Sonia. So clearly from the tailwinds going forward, we clearly see upside to the demand side, which in turn will also be a driver of operating leverage for most of the companies. Along with that, stable commodity environment is also going to support the margin improvement for the auto sector. Broadly speaking, if you see, we are seeing margins recovering from the lows. If I compare where auto sector margins are today vis-a-vis long period averages or last 10 years averages, we are still well below the normal margins. The range was about 12.5% to 15.5%. We expect it to go back to about 13.5% by FY25. So the only factor to watch out for is how commodity prices behave from here on. We have seen some inflation. Unlike last 2 years where it was hyperinflation, if we see a normal inflation, it should be very well manageable, given demand is reasonable and pricing power is also fairly good for a large part of the auto sector.
Jinesh, hi, good morning. So if we look at your growth expectations, I guess the commercial vehicle space is what you seem to be most optimistic about, though you're expecting good growth even in passenger vehicles. And apply that in terms of then picking the right stocks. Would you, let's say, go with an Ashok Leyland over a Maruti? I mean, how does it boil down to stocks?
So on relative basis, what you're saying is absolutely right. We prefer Ashok Leyland over Maruti. Ashok Leyland, given it's a pure play on the commercial vehicle space, we see continued traction on the CV demand. Clearly, there has been a good amount of pent-up demand, which is yet to come in form of replacement demand. Along with that, there could be potential benefit of scrappage policy, which will be implemented from early FY24. So that also could be potential factor, which is not part of our estimate. So if that comes in, that will be additional driver of demand, obviously what we are building it for. More importantly, it's a clean play on the GDP activity. So from that perspective, Leyland clearly is one of our top ideas in the overall auto space. Add to that, the margin improvement story is just starting. After seeing a good recovery in demand and market share, we are seeing margin as a lever coming into play for Ashok Leyland now. We do believe close to 10% margins are easily doable for Ashok Leyland as volumes pickups and operating leverage fully kicks in. So hence, Ashok Leyland is our preferred OEM play in the overall automotive space.
Okay, Ashok Leyland is a preferred OEM play. Got that. Your other stock that you like, one of the top picks in the sector is Mahindra & Mahindra. There's Tata Motors as well in that list. I want to check with you, are you concerned about the possible slowdown in the monsoons and how it could perhaps impact the rural economy and in turn impact some of these spaces like tractors? Would that put a lid on the growth in the near term?
So clearly that's one of the monitorables in terms of potential red flag for overall rural demand as well as for M&M, given close to 45% of revenues on standalone basis comes from tractors. However, if we look at the broader parameters so far, we have a very strong agroeconomic indicators, last 4 years of good monsoon, good water reservoir levels, and good terms of trade for farmers. These things can change if monsoons are really bad. Plus minus 5% is manageable. Beyond that, if it is very bad, then that's clearly one of the red flags for M&M in particular and overall auto sector in general.
Okay, got that. Jinesh, we will leave it on that note for today. Thank you very much for joining in and giving us some perspective and your thoughts on the auto space. Well, we're almost at 9:10. Let's get some final calls in before we hit the market opening. We have Sudarshan and Mitesh both back with us. Sudarshan, let me go with you. So what's the pick for 9:10?
Well, buy the Nifty on dips and you'll get them. IDFC First Bank is the buy with stop under 55.
And Mitesh, what about you? What would be the big call at 9:10 this morning?
I'll go with the buy on Canara Bank with a stop at 299 for targets of 320.
Okay, that's on Canara Bank. In pre-opening, actually looks like the market is going to move higher. So 17,680 is where we're settled at. It's a gain of almost 90 points. Going to be a big green opening. Whether we sustain that, only time will tell. A lot of IT stocks are also piling on the gain. So Infosys, HCL Tech are top of the charts. Titan, SBI, Bajaj Finance are a couple of other stocks looking pretty good. So let's see how it goes. But here is our Momentumizer segment. And today, you're looking at a stock which has a lot of momentum on both sides.
Yeah, but since about the the exact date is the 7th of February, the momentum has been more on the upside than the downside because it's been bouncing from the lows. So the stock that I'm looking at is Adani Ports. It is obviously one of the most widely traded stocks in the entire Adani group. Now, the volumes on Friday were quite interesting. There were huge volumes being traded on this one. We're talking of almost 4 crores, 28, 29 lakh shares. And the volumes are a little over 2.5 times the average that we're seeing. Now, the interesting thing is that if you're looking at the rebound, then Adani Ports is the one that has shown the biggest rebound from the lows when the decimation was at its worst. So in terms of just putting the numbers in context, the 52-week high for the stock was 987. The 52-week low for the stock was under 400. Today, the stock is quoting at closer to levels of 700. So the rebound has been 73% from the 52-week low. And the stock now is just about 30 to 31% off the highest levels. So it's been a very sharp rebound as well in Adani Ports. The one sort of catch perhaps to this is the delivery quantity. And the delivery quantity on Friday was less than 19%. If you look at the last couple of days of delivery, it's hovering between 19%, 20% on a good day. The best delivery in the last about 2 weeks that at least I've seen is around the 24th, 25th of February, when the delivery quantity was at least in excess of 25, 26%. So barring the fact that deliveries are a little on the lower side, it definitely has the price and the volume action that we've witnessed. And even, of course, in the pre-open, at least it looks like it could continue that streak even today.
Okay, all right. Thanks a lot for that, Surbhi. Well, let's go across to Mangalam. He's stopping by to tell us about Britannia. Well, Mangalam, CLSA believes it may not be such a good day.
Well, it may not be such a good day is what CLSA believes, but let's see where it goes from here because, while they've, downgraded the stock from underperform to sell and reduced their target price to 4,060, the key reasons that they highlight are one, high wheat and milk inflation will impact margins. Both wheat and milk inflation have been a problem for the company, but from the highs, they've also cooled off. They see downside risk to consensus margin estimates. So let's see how much downside risk there would be, primarily because in the third quarter, the company reported one of its best ever EBITDA margins. They expect volume-led growth in FY24. That's understandable because the last couple of years, the growth was largely price-led because of the high raw material prices. But importantly, the stock has run up 30% in the last 12 months, and that's where they believe that the room for upside is rather limited, which is why they've cut their FY23 to FY25 estimates anywhere between 1 to 11%. We'll watch out for where it goes.
Okay, thanks a lot for that. But there's been some revisions in the windfall tax. Let's get more clarity on that. Sonal has the details. Sonal, over to you.
Thanks a lot for that. Well, yes, it has been changed across all the products again. The windfall tax in crude petroleum has been hiked. It's a small hike that has come through, 4,400 rupees per ton versus 4,350 rupees per ton. However, the export duty on ATF has been cut to nil now from 1.5 rupees per litre. The export duty on diesel also has been cut to 0.5 rupees per litre versus 2.5 rupees per litre earlier. On petrol, it continues to be nil as well. So it's largely positive for the refiners, especially Reliance Industries as well. So CLSA has written a note on this. They said that windfall tax has been cut on refined products, but it has been raised slightly for crude petroleum. It is slight positive for Reliance's post-windfall margin that they are calculating. On ONGC, they have a target at 225 rupees per share. On Oil India, 300 rupees per share. On Reliance, they have a target price of 2,970 rupees per share. They say the post-tax realization for crude stays at $75 per barrel, which is a positive for oil producers.
Okay, thanks a lot, Sonal, for that. So that's on the oil and gas space. But in general, PSUs have seen a good pickup in this month so far in the first 6 days of March. SBI is now up, I think, 8% in the last 1 week or so. And a couple of others are also looking pretty good. Mitesh, before the markets open, just quick thought on SBI. Is the risk reward still favorable at 560?
Okay, so disclaimer here, we got into some futures position on Friday, so obviously have a positive view. I think the stock along with the other PSU banking lots has given a short-term reversal. I'm looking at a trading target of around 585.
Okay, all right. Thanks a lot for that. Just 20 seconds left for the markets to open. It is going to be a good opening. At least that's what the SGX Nifty is suggesting. Remember, we have a strong global handover behind us. The Dow is up about 400 odd points. FIs have been buying, but it's important to see if the Nifty A holds above the 200 DMA, and B, there is, of course, the 20 DMA as well that, Anuj was referring to, 17,700. That's the other big mark to watch out for. But the first tick on the index is well in the green. So, well, a good start to the Holy Week. The Nifty is up about 90 points, 100 points now almost, 95 points. The Sensex is up 300 points, led by two pockets. One is the Adani Group stocks. The pullback continues there. Adani Enterprises, Adani Ports, all in the green. The other is IT. So, Infosys, HCL Tech, Wipro, TCS, all in the green right now, about 0.5 to 1.5%. Looking pretty good. Tata Motors is not too bad, up about 1% over there. Reliance is fighting for the bulls this morning, up about 1%. Bharti Airtel Telecom is also looking pretty good. Titan, HDFC Life is bouncing back a little bit. ICICI Bank. So it seems to be a secular move on the upside. There's, it's really sector agnostic. On the downside, Britannia is down because of that CLSA downgrade. Dr. Reddy's, JSW Steel, Coal India, a couple of other stocks that are in the red. Hindalco and ONGC also a tad bit soft, but largely it's a day that belongs to the bulls. Now the Nifty is piling on some more weight, 112 points in the green. Remember, 17,703 is the 20 DMA, so that's a very crucial point. It's pivoting around that level right now. Does it hold on to that? Does it scale above that? Time will tell. But for now, very good opening for the market. The bulls have it today, and the advance decline ratio is well in favor of the advances.
Well, that's right, Sonia. It's a great start and a colorful one as well. Green is the color on the screen. The Nifty is doing well. The breadth of the market is just fantastic. 2,000 stocks advancing for only around 350 stocks that are declining. A few stocks that are moving around. The Adani Group stocks, they've started off well. The green Adani Enterprises, Adani Ports, both of them doing pretty well. HCL Tech as well as Infosys and TCS. We had mentioned earlier today that the Nasdaq did well overnight. Maybe the IT index bounces back today. And for the time being, you have the IT index as well as doing so well. Britannia, well, that's the biggest loser on the Nifty, as Mangalam told us. CLSA, not too optimistic about that stock, so that's why they downgraded the stock. So that's a little bit under pressure. Let's pull up a few names. HAL, they have got a refund order of around 570 crores odd, including interest of around 164 crores odd. So that's up close to around 1%. IEX, the February business update, looked a little bit disappointing. Let's see what that stock's doing. It ended lower with a cut of around 1.5% on Friday. Power Grid, they won bids for 2 projects in Chhattisgarh. So that stock as well should come up for you. And Bajaj Electricals, well, the first tick was well in the green. They had won an order for around 560 crores odd from the South Bihar Power Distribution Company. So I think that one had opened well in the green. It's still holding with a gain of around 3.5%. And CAMS, they have acquired 55% stake, in a smaller company which is into AI. So that one as well should come up for you in the screen. But a solid start is what we're seeing, Silvi.
I just want to add one more stock to that list, and that's Nykaa. That's actually reacting quite negatively to the Macquarie report. The underperform rating that they've gone with a target of 115. The concern they have with Nykaa is stiff competition and perhaps pressure on margins. And that pressure, at least on the stock price, is quite evident. Otherwise, it's a solid start. 135 up, and it's all guns blazing. Bank Nifty is performing. Mid-caps are doing well. It is a wonderful green holy start, you can say. That's the color the market has chosen to go with. It's a very good-looking screen, at least in the first couple of minutes of trade. Well, we'll keep tracking the market. Let's also get our conversation going with Rahul Chadda, Chief Investment Officer at Mirae Asset Global Investments. He's joining in now. Rahul, always a pleasure having you on the shows. Thanks for joining in, and wish you season's greetings. Of course, the festivities of the season. You tell us, I guess, with Holi coming, March coming, the market at least has changed its color from red to green. But will it last?
Yeah, so I think we continue to be conservative for first 6 to 9 months. See, what's happened is one was expecting some interest rates cuts from Fed towards the end of the year. I think that's got pushed back with this sticky, lingering inflation in the US. And that would be kind of a headwinds for markets globally. Dollar may continue to be bit strong. In India also, we are seeing signs of slowdown. But look, any medium-term investors should take this opportunity of this time correction, prime correction to add to equities exposure. So from a medium-term perspective, this is good time to buy the names we like. Near-term is going to be choppy. Near-term is going to be choppy.
Near term is going to be choppy. Okay, well, that's interesting. For now, all the volume and price action belongs to the Adani Group this morning. Adani Enterprises, Transmission, Total Gas, Wilmar, Green Power, all up about 5 to 8 odd %. So there's a big pullback over there. Market is holding up quite a bit. So when you say, Rahul, that this is a good time to be adding to the stocks that you like, what do you like in this market? Because it's very hard to generate alpha, especially at a time when growth is slowing down. There's higher rates for longer globally. What are you adding?
Okay, so I think one's got to be mindful of the fact that, look, you need that ability to or liquidity to add for next 6-9 months, or at least that kind of an attitude that it doesn't matter that these names may go down in 6 months, but eventually over 12-18 months they'll do well. So from that perspective, we continue to like private banks. Look, despite the strong NI growth, these names have not really kind of responded to the good earnings. Obviously, market was worried about the exposure some of these banks had to the Adani Group. That's where the funding for the group kind of helps these names. So they come as clear winners. Outside that, autos look interesting. Some of the industrials look interesting, though at declines, one would look to buy the industrials. And then from a medium term, I think it would be a great opportunity for consumer discretionary names. So what you're seeing is all these stocks of slowdown in the consumption space. That slowdown may last a quarter or two. But look, if you believe in the India story, if you believe in the income growth story and the consumption habits changing, I think consumer discretionary should do well from a 3 to 5 year perspective.
All right. Hi, Rahul. Good morning. In the past, you've mentioning that Zomato was giving a good entry opportunity among the new age stocks. A couple of them are under pressure today as well. Nykaa, brokerage is not too, too optimistic on that. What's your view on these new age themes? When they listed, there was a lot of interest out there. Then there was a big wealth erosion, but they have bounced off the lows. So your view on them?
Yeah, so I think somewhere around the lows, it's a good kind of a time to accumulate these names from a 3-5 year perspective. What we have in our funds is small exposure. We've got about 1 to 1.5% exposure across these names, and we're happy to hold them from a medium term perspective. Near term, like as we discussed, as things are going to be slow, market is going to react to that, competitive intensity is going to increase. But if we see what these companies have done over the last 2-3 years, despite strong competition, they've gained kind of a significant foothold in their respective categories. They've got a good connect with the consumer. And longer term, I think that's what matters. So one's got to look beyond this near-term noise. And from a 3-year perspective, I think these are good accumulation points. Here or 10-20% are good accumulation points for the likes of Zomato, Nykaa, etc.
What about banks, Rahul? I mean, we know what's happened, especially PSU banks. That's what sort of I want to drive your attention to. It's all linked to obviously what we've seen with the Adani Group, and there's a huge relief rally that seems to be playing out as well. But if you go beyond the headlines, at least with respect to this one conglomerate, do you think the rest of this year can be a strong one for PSU banks in specific, or would you still stick to private names?
I think bulk of our exposure would be private. We would not see PSUs outperform private like the way they did in 2022. And why I say that is, look, NI growth is going to slow down from here. It's going to be still a healthy double-digit number, but not the kind we saw in the fourth quarter. Largely on coming back of NIMs contracting, you'll see provisioning pick up, and increasingly banks are going to talk about. CD ratios are going to go higher. So as that happens, market is going to be conservative in approach, and that's why markets would kind of prefer private banks over the PSU banks. So it's not end of the story for PSU banks, but clearly the outperformance they showed in 22 over private banks is unlikely to be repeated now.
We were just having this discussion about autos a while back with an analyst who tracks it closely, and he said that after 5 long years of an underperformance, autos are finally coming back. But I beg to differ on that, because growth has still not come back in a big way, and there are still many hurdles, right? Whether it is the impending monsoon situation, whether it's just the rural economy which has crumbled and has not come back in a big way. Your thoughts? Is it safe to invest in autos in a big way, or are you still cautious here?
Okay, so there would be pockets in autos which are doing well. Again, what we've seen is, despite what you talked about, rural economy, tractors have held on well. They've come back strongly. UVs are doing well. This is the trend across urban, semi-urban, and rural India. We've seen two-wheelers kind of a struggle, and that's largely because of the penetration issue. But the four-wheelers should be okay. So from our positioning, we are largely in four-wheelers, whether it's the UV plays, whether it's the passenger car plays like Maruti, etc. I think those names should kind of do well. And look, what's happened is there's a huge pent-up demand which is coming. If you look at the average age of the vehicle in India, that's about 8 to 9 years. And with all these new infotainment systems in cars, there is this feel that one needs to upgrade. And I think that's where this momentum can continue for a while. And what one has to also understand is, look, there is a inflationary pressure on consumers' wallet. And within that, he's prioritizing spends. So it's all going to be relative. In absolute terms, you may not see high growth rates, but from a market perspective, what matters is sectors where relative growth rates are better. And I think that's where autos would hold on, probably like a retailing sector here.
Rahul, what about the IT pack? That had a good run. Last year, they had, they were big underperformers. But at current reckoning, some of these companies, the growth may slow down, but maybe margins will hold out, and they've got very, very clean balance sheets. What's your view on IT?
I think which is where these names could be good protectors of capital on the downside. Like the way you said, highly likely growth slowdowns from here. But because the percentage of subcontracting reduces, you'll see the margin tailwinds kind of come through. Some of the rupee benefits would flow through. So they'll do relatively well in terms of earnings. Earnings could be anywhere around 8 to 12%. They are strong free cash flow generators. So these names can be a reasonable returns name, not a high returns, but I think they can give returns in line with the earnings of 8 to 12%.
Okay. Rahul, sort of more broad brush, I want to go back to the first point you made that for the medium-term investor, there are a lot of opportunities here, but near-term, you are cautious. Can you elaborate on that? I mean, we know the narrative and the talk points are still the same. Rise in yields, whether central banks are going to stay higher for longer. Which of these do you think can be an unexpected shocker of sorts for the market, or is much of this getting priced in because this narrative has been ongoing for a while?
Yeah, so I think what's happened is markets got a bit complacent with this narrative, and this is what we were discussing internally. That look, invariably when rates move up so much, something cracks. So obviously these rates have moved in last 18 months, and it seems like for next 6-9 months they're going to be higher. So it's highly likely that we see some of the things capsulate. Already you've seen some pressure come through in the REITs, global REITs, where look, their rental yields are under pressure, their interest burdens are going down. So some of these guys have stopped the redemptions, etc., or withdrawals, etc. So that's why you're seeing some pressure points coming up. You'll see more pressure come through indebted kind of an economies. We saw that in the UK and all these things. China is something one is watching closely, because China is where one has accumulated a lot of debt over 10 years. So what happens in terms of convertibility of capital over there? What happens when China opens up and some of the capital flight happens? That's to be watched. So there are a lot of macro risks on the horizon. I agree, none of them has played out till now, but look, that doesn't mean it doesn't play out in 6-9 months. And should any of these risks play out, obviously we'll get great entry points for a market like India, where the structural story is very sound and intact.
The way the market is really piling on the gains right now. The Nifty is up almost 160 points and the Sensex is up 560 points. Rahul, this is an interesting juncture in the market, right? A lot of people believe that there's never been such a long patch when the markets can close in the red for so many months. So this month is going to be a good one, the month of March. But even if we do see a rally, do you think it's going to be short-lived? I mean, there seems to be no real positive trigger to take this market sustainably higher. What, in your sense, is the trajectory that we would see for the next couple of months? Will it be a cautious one? Or, should you just step back? Or do you think that the worst of the sell-off is now behind us?
Okay, so if you look at the stagflationary setups, which in a way we are in, markets go nowhere basically. So we will just move in a 5-7 band and spend all our energy trying to analyze that band. I think it makes sense for the time being to be in fixed income, and as one gets clarity on inflation coming under control in kind of an coming months, coming quarters, etc., and you see some clarity of monetary policy becoming more looser, becoming a tailwind for the economic growth, that is where one should take aggressive bets on the markets. But right now, again, for good markets like India, the best is going to happen is type correction. They're going to move in a range. For vulnerable markets where a lot of debt's been accumulated, we can see some downside. So we can see some cracks in coming quarters.
All right, Rahul, finally, before we let you go, what's the range you're looking at on the Nifty? What's the best case scenario? By the end of this year, can we clock a fresh all-time high? I know it's a little bit of a tricky one, but a lot of retail audience out there, they would like to know, what's the broad range? Worst case, best case?
No. Yeah, I think we can clock an all-time high. And why I say that is, look, the share composition of the index. So, and here I'm talking more from a MSCI perspective. Same for Nifty. I think financials are about 25-30% of the index. And if financials do well, obviously markets can clock all-time high. You don't see any significant downside for IT. That the digitization is kind of a core structural theme. So IT should though compound slowly at 8 to 10%. So again, by the end of the year, fair to say that we can see an all-time high.
All right,
it's a strong market, actually, 165 points up. Looking quite solid, and the IT sector is actually charging away and firing on all cylinders. Banks are doing really well. It's a very widespread move, and it's building on what we saw on Friday, where it was largely, the Adani rebound that the market was tracking. This is a pretty good-looking screen. Can't complain, at least as of now.
Oh, it's good that we're going into Holi with some green color, right, in the market. Okay, I guess that joke's going to continue through the day. At some point, we're going to get bored of it. But for now, we're enjoying it. The Nifty looking pretty good. MGL is really the stock of the moment, 5% higher. It's the first acquisition, I think, that MGL has done. They've acquired Unison Enviro Private for 530 crores, as we told you earlier, 7% higher now. More details on what brokerages are making of that in a bit. But in the meantime, M&M Financial is the company on our radar. They reported a very good disbursals in February. It was a 53% growth year on year. Their collection efficiency stood at 97%. To discuss more on how the business momentum has panned out, the likely impact for rising rates, Ramesh Iyer, the Vice Chairman and Managing Director at Mahindra & Mahindra Financial Services, joining in. Mr. Iyer, good morning and thanks for joining us. The going is very good so far, but there is one impediment, which is perhaps the fact that, the monsoons may not be that great. There's the El Nino effect, and that could hit a couple of pockets, whether it's the rural economy, whether it's tractors, even the small car segment. You cater to a lot of these pockets. Are you concerned that growth would slow down? And if not, what is the ballpark range that we're looking at over the course of the next few months in terms of growth?
Yeah, so I think the sentiments are pretty positive even now. And as you said, the numbers look pretty good for us. And this has not been just one quarter. We've seen it over the last few quarters that the numbers are good. And the demand is definitely coming in from all products, all geography. As you mentioned, if the monsoon was to be a little slow for whatever reason, though it's too premature, but even if it was to be, I think the rural cash flow is just not farm dependent. And we have been talking about it several times, that there are multiple sources of revenue that we are seeing. The infrastructure is picking up. So definitely, maybe through monsoon, if there is something that slows down, we definitely believe that it'll be more than offset by the infrastructure opening up and the consumption of assets will happen. So not really much concern at this stage, but definitely we'll watch closely. But overall sentiment seems to be pretty positive.
So, good morning, Mr. Iyer. So you're sounding pretty optimistic, and that's good to know, that you're not seeing any kind of slowdown as of now. But Mr. Iyer, what about FY24? You believe that AUM will grow at around the 20% odd? And NIMS, you had said, it should be around that 7.5% plus or minus 20 bips on either side, holding on to both those two numbers?
So clearly, as far as NIMS is concerned, we will hold on for two reasons. One, the product mix change brings better yield. When you do more of pre-owned vehicle, they come at a different yield level. And that's one reason why the NIMS will get protected. Second is we have already passed on 50-60 basis point. That's the impact that we saw in our borrowing cost, while the overall cost went up by 200 basis point plus. But since we have a good ALM match, our impact of borrowing was only about 60-70 basis point, which we have passed on. Put these two together, we don't see that NIMS should be something of a concern. As far as growth is concerned, we've done so far about 45,000 crore, add another 3-4,000 crore normally. So I think this will be our highest disbursement ever for many past years if compared. So I think maintaining a disbursement growth of 20% over this will depend on what's the overall OEM sales. We are retaining our market share and also growing in some segment. But clearly, growth is the trajectory. And as you know, we have put out our strategy for 25, which is doubling the balance sheet from 22. I think we are doing pretty well on that.
Mr. Iyer, hi. I actually exactly want to come to that. If you could elaborate on which are the segments where you are gaining market share and the ones that are really pushing the growth levers for you.
So I think in almost all product, we are gaining market share. I mean, pre-owned vehicle, we are definitely growing. It's not by market share, but clearly the volumes are very, very high. As far as Mahindra Auto business is concerned, tractors are concerned, we were not a significant player in heavy commercial vehicle. There we see traction for us. I think put any product, even if you look at the car segment where we are, and I think in no segment we are doing less. I think we're growing in every segment, and therefore the confidence that the growth would be maintained.
So in terms of rural cash flows, you are not seeing any stress at all in the segments that you cater to? I'm asking because, you know, a lot of the companies, whether it's FMCG, even many of the auto guys, the OEMs that is, have indicated that there is stress in the rural economy and it's reflecting on cash flows. You don't see that situation play out?
If you look at, what are the indicators for the cash flow? One is if the volumes are growing, which means people are bringing in 25% margin and then buying the vehicle. So that's a very clear reflection of the cash flow doing well. The other is the collection efficiency. We maintain 97% plus collection efficiency. You look at our stage 3 and stage 2 are showing continuous decline, and we have not resorted to any major repossessions for settlement or etc., which means that even people who are defaulting are repaying. I think putting all this together, we feel that the cash flows are getting diverted to need-based uses rather than aspirational uses, and therefore you may see different commentary from different set of people. We cater to the use and using segment. People use and repay their installments. They are all buying vehicle, and that's based on the underlying use of these products.
Okay, all right. Mr. Iyer, let's talk about a smaller part of your business as of now, the housing finance business. The gross NPAs out there are very high. But, in the past, you were telling us you're expecting the mix to change as well. So tell us, what is the growth you're looking at out there? What about the asset quality? Where do you see this number stabilizing?
So as we discussed in the past, currently we see annual disbursement, the monthly disbursements have become almost equal, rural and affordable housing, which means over a period of time, about 20-25% of the book will come from affordable housing, and our target is to take it to about 40%. Once that happens, the overall ticket size changes, the overall NPA composition changes. We experimented this model by going deep rural, doing small ticket loans for house upgradation, house addition, etc. I think this segment of customers, once they go through some disruption, takes much longer. We don't lose money, but to get corrected will take a little longer. And that's a reason we resorted to a mix change. And going forward, you would see a disbursement growth very clearly, and it's a small base. We are currently about 8,000-9,000 crore of book. There again, we are talking of in 3 year a 20,000 crore book with 50% coming from affordable housing.
Okay. Just to go back on the margin point, Mr. Iyer, you did mention that you've passed on the increase in cost of funds to your borrowers. Were you referring more to trends out of Q3, or is this something that you've been continuously doing in Q4? A lot of people are penciling in another 25 basis points rate hike, for instance, in the April policy. How do you see your cost of funds shaping up incrementally? And does the market have the elasticity for you to keep passing it on to customers?
So, in the third quarter is where we passed on 50-60 basis point, and that was the increase that we had to face in our borrowing. Good news for us is we've been upgraded to AAA, and that also gives us a 20 basis point benefit from the market borrowing. And, therefore, even if there is a 25 basis point increase going forward, not necessarily we'll have to pass on. And also, we have increased our pre-owned vehicle disbursement, which comes at a different yield. And therefore, passing on of some rate, absorbing some, of course, and then changing the product mix, improving the yield are the reasons for the protection of the NIMs.
So do you have any further levers to improve your operating efficiencies and bring down your credit costs?
Clearly, the answer is yes. Credit cost is outcome of 2 or 3 things. One, how is the general cash flow of the market that we talked about? They are doing pretty well. 2 is extremely defaulting customers who are not able to earn and pay. We would resort to settlement or take back the vehicles from them. And as you know, on an 18 months old plus vehicle, we are already carrying a very high provision. And those are the customers whom we would target in the next couple of months to make sure that either they settle or they give back their asset for settlement. And that should help bring down the overall credit cost.
All right, Mr. Iyer, I got the point on the smaller part of the business, the housing finance, which the book will go from 9,000 to 20,000 crores. But what about the asset quality? That's getting a little worrying, right? More than 15-16% gross NPAs. Explain to us why is it high, and also how do you see this improve going ahead?
So clearly, as I mentioned, this was a model that we experimented going more deeper, and then it's the ticket size was a lakh and a half for room improvement, room addition, etc. And they are definitely defaulting, and they are at a high NPA level. But we have seen month after month improvement happening there. And we have given ourselves 2 or 3 quarters before it can come down substantially. And we are confident they would, because there are underlying asset. The LTV was just about 20-25%. So the customers are there, assets are there. It's just that they need to start earning, and we are seeing that beginning to happen. As far as the overall book composition is concerned, as I said, if 50% of what is going to remain rural, and it's 50% going to come from affordable. And if you look at the last 1 year disbursement, the NPA levels are sub 3% and so. So clearly there is a visibility of how the book would look like in a year plus from now. And there is a clear action plan for how do we want to correct the current book.
Okay, all right. We will leave it at that. Thanks a lot, sir, for joining in and speaking to CNBC TV 18. That's M&M Financial. Saying that the sentiment is pretty positive at the moment and the numbers are looking good. Rural cash flow is not a worry for them, although it is for the industry, but for them, they're not too concerned. They're saying that yields have helped in improving their net interest margins as well. Let's slip into a quick break. On the other side of the break, we have with us Ravindra Kumar, who's the Chief Executive Officer at Lupin Diagnostics, and Prakash Agarwal of Axis Capital, who tracks the space closely. We'll do a complete deep dive into the diagnostic space. We'll also connect with Patanjali Keswani, Chairman and Managing Director at Lemon Tree Hotels, for a chat on the big recovery that we've seen in demand and the trends in occupancy. Stay tuned.